November 15, 1923, Berlin, Germany. A factory worker named Heinrich clutches his weekly wages, 4.2 trillion paper marks, and sprints through the streets toward the nearest bakery. His heart pounds because he knows the truth. By tomorrow morning, that money will buy half as much. By next week, it might not buy a cup of coffee. He arrives to find the price of bread has tripled since yesterday. It now costs 200 billion marks for a single loaf. The baker's wife stands behind a cash register, overflowing with worthless paper. The currency has become so worthless that children use stacks of banknotes as building blocks. Families wallpaper their homes with 1,000-mark bills because it's cheaper than buying actual wallpaper. But across town, Heinrich's neighbor, Wilhelm, walks calmly into a shop and purchases a month's worth of groceries with a single gold coin. Same day, same city, same economic apocalypse. Two completely different realities. This isn't fiction. This was Weimar Germany. Fast forward to September 15, 2008. Lehman Brothers files the largest bankruptcy in American history, $639 billion in assets gone. Within days, the stock market erases $10 trillion in wealth. Retirement accounts vaporize, yet some people walk through that crisis barely scratched. Fast forward again to March 2023. Silicon Valley Bank experiences the fastest bank run in history. $42 billion withdrawn in a single day. A bank worth $16.8 billion at market open becomes worthless by Friday afternoon. 48 hours from thriving to seized. Here's what keeps me up at night. When you study every major banking crisis of the past century, from Weimar Germany to Argentina's Corralito to 2008 to last year's failures, you find the exact same pattern. The same assets survive. The same assets go to zero every single time. Not theory. Historical fact. Today I'm showing you the 5 specific assets that protected wealth through every banking crisis in modern history. More importantly, I'm showing you exactly why they work. And I'm revealing which assets went to zero so you know what to avoid when the next crisis hits. Because the question isn't if, it's when. And the difference between survival and ruin comes down to one thing: whether you own the right assets. The pattern every banking crisis follows. Every banking crisis follows the same pattern. Stage 1, excessive debt accumulates during good times. Stage 2, a trigger event causes confidence to crack. Stage 3, bank runs begin as depositors rush for exits. Stage 4, asset prices collapse from forced selling. Stage 5, currency devaluation as governments paper over damage. We saw this in the Great Depression when 9,000 banks failed between 1930 and 1933, wiping out deposits. We saw it in Argentina in 2001 when the government froze all accounts, limiting withdrawals to $250 per week, trapping $70 billion. We saw it in 2008 when Washington Mutual collapsed after depositors withdrew $16.7 billion in 10 days. The timeline accelerates. In 1930, bank runs took weeks. In 2023, Silicon Valley Bank went from announcing a capital raise to complete collapse in 36 hours. Modern panics move at digital speed, but the pattern remains identical, and so do the assets that survive. Asset number 1, gold. And I don't mean gold as some abstract hedge. I mean gold is the single most reliable crisis survivor in recorded financial history. Let me show you the brutal math. In January 1919, 1 ounce of gold cost 170 German marks. By November 1923, that same ounce cost 87 trillion marks. Gold didn't just maintain purchasing power during Weimar hyperinflation. It doubled its real value while everything else burned. Those who converted paper marks to gold could still buy property and food when neighbors used wheelbarrows of cash to buy bread. During the 2008 financial crisis, gold reached a new all-time record of $1,011 an ounce in March 2008, a rise of over 50% in just 9 months. Gold initially dropped during the panic as investors sold everything for cash. This is critical. During acute liquidity crises, even gold gets sold temporarily. But by year-end 2008, gold posted positive returns while stocks lost 38%. After rising 2.6% in 2008, gold increased 12.8% in 2009 as the United States was mired in the economic crisis and the Federal Reserve ramped up quantitative easing. For the 5-year period that encompassed the financial crisis, gold nearly doubled in value, rallying from just above $825 to north of $1,650 per ounce. From 2008 to 2012, the value of gold increased 101.1%. By 2011, gold reached an all-time high of $1,917.90 an ounce. During the 2008 financial crisis, global stocks plummeted 49%, while gold saw an impressive rise of 47%, cementing its position as a reliable hedge against systemic risk. Here's what most people miss. Gold has zero counterparty risk. A bank can fail, a government can default, a corporation can go bankrupt, but gold cannot go to zero because it doesn't depend on anyone else's promise. It exists. It has value. It has for 5,000 years. Right now, as of late 2025, gold has reached all-time highs above $5,000 per ounce. Central banks accumulated over 1,000 tons in 2023 and 2024. They're not buying because everything is fine. They're buying because they see what's coming. Pattern recognition verified, undeniable. Asset number 2, agricultural land and farmland. This surprises people because they remember 2008 and think real estate collapsed. Residential real estate collapsed. Speculative housing collapsed. But farmland did the opposite. Here's the brutal math. During 2008, the S&P 500 lost 46%. Conventional real estate posted double-digit losses. Farmland, according to the NSREF index, gained 17%. Positive 17% during the worst financial crisis since the Great Depression. During the dot-com crash from 2000 to 2003, the S&P lost 42%. Farmland gained 14%. From Q3 2000 to Q1 2003, the S&P 500 posted a cumulative loss of 42%, while the NSREF Total Return Index posted a gain of 14%. During COVID, when markets crashed 37% in weeks, farmland rose 7% in 2020. Since 2000, the S&P 500 has posted negative returns in 28 quarters. In 26 of those 28 quarters, farmland posted positive returns. That's a 93% hit rate during market downturns. The mechanism is brutally simple. People always need food. Demand for agricultural products is inelastic. It doesn't disappear during recessions. Only 7% of Earth's surface is suitable for farming, creating permanent scarcity. And farmland produces cash flow through crop yields, regardless of what financial markets do. During the Great Depression, farmers who owned their land outright actually prospered. They sold goods at rising prices while urban goods deflated, paid off debts with devalued currency, and maintained self-sufficiency while urban populations starved. There's a reason billionaires like Bill Gates have accumulated over 270,000 acres of farmland. There's a reason aristocratic families preserved wealth for generations through agricultural estates. Land produces, land persists, land survives. The caveat? The 1980s farm crisis saw farmland values drop 40%. But look at why. Farmers had borrowed at 95% loan-to-value ratios. When rates spiked, they couldn't service the debt. The lesson isn't that farmland fails. It's that leverage destroys everything, even the best assets. Asset number 3. Hard currencies from stable countries. And here's what blows people's minds. During local currency crises, holding physical cash in a strong foreign currency can be the difference between survival and ruin. Let me tell you the Argentina story. In December 2001, the Argentine government implemented the corralito. They froze all bank accounts and limited withdrawals to 250 pesos per week. But here's the devastating detail. Dollar deposits in Argentine banks were forcibly converted to pesos at 1.4 pesos per dollar. Then the peso collapsed to 4 pesos per dollar. Do the math. If you had $100,000 in an Argentine bank, it got converted to 140,000 pesos worth just $35,000. You lost 65% overnight by government decree. But Argentines who kept physical dollars outside the banking system preserved their wealth entirely. The Swiss franc has been the most consistent safe haven currency for decades. Since 1974, the US dollar has devalued approximately 75% against the Swiss franc. During every major conflict, the Swiss franc strengthens, averaging 0.85% gains per month during geopolitical stress. During 2008, the Swiss franc appreciated so significantly that the Swiss National Bank had to intervene to stop it because it was hurting Swiss exporters. That's how powerful the safe haven effect becomes. The mechanism is straightforward. Switzerland is politically neutral, has strict banking regulations, low inflation, diversified economy, and holds the 8th largest gold reserves in the world. When the world panics, money flows to stability. Pattern recognition verified, undeniable. Asset number 4. US Treasury bonds from stable governments. This is the traditional safe haven, and the data largely supports it with important caveats. During 2008, long-term US Treasury bonds gained 17%, while stocks fell 49%. During the LTCM collapse in 1998, Treasuries gained 7%. During the dot-com crash, Treasuries gained 13%. In November 2008, Treasury yields briefly went negative. Investors were literally paying the government to hold their money because they trusted nothing else. This is the flight to quality phenomenon. The mechanism? The US Treasury market is the largest and most liquid in the world, $28.5 trillion with daily trading volume of $910 billion. During crises, liquidity is survival. Treasuries provide that when everything else freezes. But here's what critics miss. In 2022, Treasuries posted negative 13% returns. In March 2020, even Treasuries were sold as institutions desperately raised cash. The lesson is short-term. Treasury bills remain the most reliable safe haven. Long-term Treasuries carry interest rate risk. Diversification matters even within safe havens. Asset number 5. Dividend-paying stocks from essential businesses. Not growth stocks, not speculative tech. Companies that produce things people need regardless of economic conditions and pay you while you wait. Here's the brutal math. During 2008, S&P 500 stock prices fell 55%. But S&P 500 dividends fell only 6%. Earnings per share collapsed 92%. Dividends barely budged. Across all recessions since 1946, the average dividend cut is just 0.5%, while stock prices fall an average of 32%. Dividends are 10 to 15 times more stable than stock prices during downturns. The companies that matter provide essential services. Utilities keep lights on regardless of recession. Healthcare companies treat the sick regardless of unemployment. Consumer staples sell food and household goods regardless of GDP. Telecommunications provide services people won't cancel. The mechanism is simple. Essential demand creates essential cash flow, creates essential dividends. When you own these businesses, you don't need to sell at the bottom. You collect income, reinvest during panic, and emerge stronger. The warning? Avoid financial sector dividends during banking crises. Bank of America yielded over 5% in 2007. By 2009, it yielded 0.23% after forced cuts. Citigroup's dividend was essentially eliminated. During banking crises, bank dividends fall first. What goes to zero? The assets that destroy wealth? Now let's talk about what goes to zero, because understanding what survives is only half the equation. Bank stocks during banking crises are lottery tickets with negative expected value. Lehman Brothers stock traded at $65 per share in 2007. After September 2008 bankruptcy, it traded at 21 cents, a 99.7% loss. Washington Mutual traded at $46 in 2006. When trading was halted during seizure, it was at 16 cents. Silicon Valley Bank fell 60% on March 9, 2023, then another 62% before being halted. The pattern is consistent. Bank stocks can and do go to zero because banks operate with 90% or more debt. When confidence cracks, equity holders are wiped out first. Subordinated bank debt, particularly @1 bonds, can be wiped out by regulatory decree. Credit Suisse. @1 bondholders lost $17 billion overnight when Swiss regulators wrote their bonds to zero during the UBS merger. These instruments are designed to absorb losses during crisis. Uninsured bank deposits above FDIC limits are exposed to bail-ins. In Cyprus 2013, depositors at Bank of Cyprus, with more than 100,000 euros, saw 47.5% of their excess deposits forcibly converted to bank shares trading at 20 cents on the euro, an 80% loss. And local currency during hyperinflation goes to zero in the most devastating way. Venezuela's bolivar lost 99.99% of its value. The currency required 14 zeros removed through 3 redenominations. 8 million people fled. Zimbabwe printed $100 trillion bills before abandoning the currency entirely. Prices doubled every 24.7 hours at peak inflation. The warning signs flashing right now. So, where are we seeing these warning signs right now? Because the same patterns that preceded every previous crisis in history are flashing amber, and in some cases red, across multiple indicators simultaneously. US banks are sitting on $337.1 billion in unrealized losses on their securities portfolios as of Q3 2025. This marks the 14th consecutive quarter of unrealized losses, matching the streak from 2006 to 2009, the period leading up to the Great Financial Crisis. Commercial real estate delinquencies have reached nearly 12%, higher than the peak during the 2008 financial crisis. $936 billion in commercial real estate mortgages mature in 2026, an 18.6% increase from 2025 maturity levels. These buildings are worth 30 to 50% less than when the loans were originated. Auto loan delinquency rates have hit 3.88%, a 15-year high. Subprime auto delinquencies have reached 15.78%, the highest since tracking began in 2000. Credit card balances have hit $1.2 trillion, an all-time record. Credit card delinquencies are rising, now above 3%. US public debt now exceeds $38 trillion. Annual interest payments have surpassed $1 trillion for the first time in history, more than the entire defense budget. The debt-to-GDP ratio has surpassed 120% and climbing. Ray Dalio, founder of Bridgewater Associates with $125 billion under management, has warned repeatedly throughout 2025 that we're in the late stages of a major debt cycle. He forecasts a potential U.S. debt crisis emerging somewhere between 2027 and 2029. He compared current conditions to 1929 and 1937, noting that the parallels are striking. Same pattern, same stages, same outcome. The question isn't if it will happen, it's when, and whether you'll be positioned correctly when it does. What you need to do right now. So here's the question that actually matters. What do you do with all this information? Because knowledge without action is worthless. First, evaluate your exposure to assets that go to zero during banking crises. Check your bank balances against FDIC insurance limits. $250,000 per depositor per bank per ownership category. If you're above that limit, you're taking unnecessary risk for zero additional return. Spread deposits across multiple FDIC-insured institutions. Second, build positions in crisis-surviving assets before you need them. This is critical. You can't buy gold or Swiss francs or farmland during the crisis when premiums spike and liquidity dries up. You buy them now during calm periods at reasonable prices. For gold, allocate 5 to 15% of your portfolio depending on your risk tolerance. Physical gold in your possession or allocated storage, not paper gold. For agricultural exposure, consider farmland REITs like Farmland Partners or Gladstone Land if you can't buy actual farmland. For Swiss franc exposure, currency ETFs like FSF provide easy access. Third, focus on quality dividend payers in essential sectors. Utilities, healthcare, consumer staples, telecommunications. Companies with histories of maintaining and growing dividends through multiple recessions. Screen for companies with dividend payout ratios below 60%. Look for companies with 20-plus years of consecutive dividend increases. Fourth, maintain liquidity in short-term treasury instruments. Keep at least 10 to 20% of your portfolio in cash or cash equivalents. Treasury bills maturing in 3 to 6 months. This gives you dry powder to buy assets when they're on sale during crisis pricing. The choice that determines everything. Remember Heinrich and Wilhelm from November 15, 1923, Berlin. Same city, same economic apocalypse, same day. Heinrich sprinted through the streets clutching 4.2 trillion marks that would buy half as much by tomorrow. Wilhelm walked calmly with a single gold coin that bought a month of groceries. The hyperinflation didn't discriminate between them. The banking crisis didn't choose victims randomly. The currency collapse didn't pick winners and losers based on luck. Their preparation did. Their asset allocation did. Their understanding of history did. Heinrich trusted paper promises backed by a bankrupt government printing money. Wilhelm owned real assets with intrinsic value. Heinrich's entire life savings evaporated. Wilhelm preserved his wealth and bought property from desperate sellers at depression prices. That choice, that single difference in what they owned, determined their family's financial futures for generations. Wilhelm's grandchildren inherited wealth. Heinrich's grandchildren inherited poverty. Here's the brutal truth. Banking crises are not random events. They're not acts of God. They're not unpredictable black swans. They're the inevitable, predictable result of excess debt, overvalued assets, and misplaced confidence reaching their mathematical limits. Every generation experiences at least one major banking crisis. Your grandparents had the Great Depression. Your parents had 2008. You will have yours. The only question is whether you'll be prepared for it or devastated by it. The difference between those who emerge from crisis stronger and those who emerge devastated comes down to one thing: what they owned when the music stopped. Not what they owned when times were good, what they owned when confidence cracked and the system froze. If you found this valuable, if you're realizing that everything you thought you knew about asset protection needs to be reconsidered, hit that subscribe button right now. Drop a comment telling me which asset class you're most focused on building. Are you accumulating gold? Researching farmland? Building dividend portfolios? I read every comment. And here's what you should do right now today, before you move on to the next video. Open a spreadsheet, list every asset you own, put each one in a category: survives or fails during banking crisis. Be honest. If you're not sure, assume it fails. Then calculate what percentage of your wealth is in the fails category. If it's more than 50%, you have work to do. If it's more than 75%, you're dangerously exposed. Start repositioning. Not all at once, but start. Because when the next crisis hits, and it will hit, it will be too late to prepare. The time to buy gold is before the currency crisis. The time to buy farmland is before the food crisis. The time to buy Swiss francs is before the dollar crisis. The time to build your dividend portfolio is before the stock market crash. The time to position is now, while it's still calm, while prices are reasonable, while everyone else thinks you're crazy for preparing. Because one day, maybe next year, maybe in 5 years, you'll wake up to news of a bank failure, then another, then bank runs, then frozen accounts, then currency interventions. The pattern will play out exactly as it always has. And on that day, you'll either be Heinrich sprinting through the streets with worthless paper, or Wilhelm walking calmly with real assets that hold value. The crisis won't discriminate, but your preparation will determine everything.